Australia's Business Channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening, it's great to be back again, and I hope you enjoyed last week's special show. Tonight I'm looking forward to providing your Monday night dose of property education. This is Your Money, Your Call, and I have two fabulous regular guests here tonight to help me answer all of your questions. But before I introduce you to them, here's the property news for the week. And the Brisbane housing market recorded another encouraging year of house price growth over 2014, according to the Domain Group senior economist Andrew Wilson. Brisbane's median house price increased by 5.9% over the year, compared to 5.1% over 2013. Now, he noted that Brisbane's housing market revival was late compared to most other capital city housing markets, which were driven by the sharp cut in interest rates in 2012 and 2013, but it's now squarely on track. Brisbane median house prices are set for another solid result through 2015, rising again by between 5 and 7%, which will likely only be behind Sydney in terms of capital city performance. And New South Wales Fair Trading has accused the Bresic Whitney Agency of advertising two auction properties at prices below estimates that were given to sellers in written agreements. The more serious price discrepancy alleged was at Double Bay, where the publicly published price guidance reputedly didn't match the private agency agreement documentation in the office paperwork. The apartment had a reported price guide of over $1.5 million last November, but investigations revealed the selling price estimate in the agency agreement at the low end of $1.6 million. The New South Wales Premier Mike Baird recently elevated the issue into an election policy. New South Wales estate agents were reminded last weekend that they must tell buyers the same price guidance estimate they have given to their vendors. Depending on the success of his re-election, Premier Mike Baird has vowed to crack down on price underquoting and on overquoting too. We're all standing by to answer your questions, so get them ready. And to help me this evening, I've asked real estate author Peter O'Malley and Brad Beer from BMT into the studio. And so if you have a question for anyone on the panel this evening, don't wait. Call us right now on 1300 30 34 35 or email your question to me now at property@skynews.com.au. Welcome to the program, and let's not waste another moment and get started. Good evening, gentlemen.
Good evening, Margaret.
So first of all, Brisbane, Brad, a lot of people have been talking about Brisbane for quite some time now, and it looks like now it's starting to hit its straps. Listings are just the same average, but we're getting more visits per listing. So that indicates that demand is creeping up while supply is staying about the same.
Yeah, and some movement. I think Brisbane's had a lot of positive talk on this show with us for probably a period of time.
Things like insider trading, you think we've artificially inflated the prices?
Maybe they listened and all started buying them.
Maybe we should have bought first before we started doing that.
Yeah, maybe. But interestingly, the mid to upper range price properties are the ones that move, which is probably even still a positive for the type of things that you and probably I also tend to invest in the sort of the, I guess, the outer ring and the not quite so expensive properties that generally are the things that we have bought and I do like. So that's probably a positive for still continuing to look there, I suppose.
Yeah, exactly. Peter, what has actually happened in Brisbane is we've seen most of the price growth occurring in that 5 to 10 kilometre ring around Brisbane. But some say, and I certainly agree, that because of that now and because the median price in that ring is now slightly over what the average Brisbane family can afford, we will see that ripple out into those lower price markets, and that usually happens, doesn't it?
Indeed. As we're seeing across all sectors of the investment economy, the market's chasing yield, and there is yield, good yield in broader Brisbane, and the market will move that way.
Yeah, in fact, Brad, I think Brisbane is one of the only capital cities, or one of the few capital cities, I should say, and Adelaide is another one, where many of the outer suburbs are actually achieving yields higher than 5%, with Sydney sitting still in the very low threes, Melbourne in the mid to high threes, and Brisbane just languishing around the high threes with a couple of suburbs in the fours. But both Adelaide and Brisbane both have that 5% yield, which of course drives investors into the market.
Especially when we've had, you know, substantial, and I think the information also says from Andrew, Sydney's had the price growth and the most price growth, and, you know, big auction clearance rates and price movement, which ultimately drives yields down. So investors that were probably looking at Sydney are saying, well, the cash flow is a bit difficult now, or a lot more difficult than it was.
Interestingly enough, though, Peter, there are still a lot of buyers still creating frenzy in the Sydney market, and my biggest fear now is that those last ones that come in 2015 will then face in 2016 the very real possibility that they may even lose 5% off the prices that they're paying to go in.
Oh, if not more. The Sydney market is clearly a sell if you're an investor. I'd be going out, not in, based on these prices, and as Brad said, the yields have been decimated. It's very good selling at the moment.
Absolutely. Now, while I'm talking to you, Peter, Mike Baird has committed now to this whole underquoting, overquoting argument. You know, it seems to be a very long time since the auction laws were changed to supposedly prevent the underquoting, but here we sit with it still happening. Why? Is it not policed well enough? Is it, you know, is the law not strong enough? What's going on?
Well, the last time we saw a dramatic change in real estate law was back in 2003, when the Carr government then stamped down on dummy bidding.
Yep.
And what that did is that highlighted to most of the bidders out there at the auctions on the weekends that they weren't actually bidding against 4 or 5 other parties. They were bidding against one, if none. And since dummy bidding has been outlawed, what real estate agents have defaulted towards is underquoting, because how do you have an auction with one buyer? And the answer is you can't. So well, to get multiple buyers there, they've been putting an artificially low price out to attract a crowd.
And which is unfair, because, you know, you go along and people are often quite weak emotionally. They'll get carried away by the big tide of what's going on. A lot of them know that they've got a price point that they have to get out at, but can't do it. The whole competitiveness of the day, falling in love with a property and then wanting it, it's actually creating a situation where people are biting off more than they can chew.
Genuine competition is a fact of a market, but this is not genuine competition. Yes. This is misleading people, and the conduct that a lot of agents have carried on with in the last 5 to 10 years would not be accepted in any other industry, and it shouldn't be accepted in the real estate industry.
Yes.
And the Baird government's done exactly the right thing in stamping out, or aiming to stamp out, a despicable practice.
Brad, has it happened to you?
No, I can't, but then I suppose I've got two thoughts on it, and one is that at auction, I've not been one to buy at auction. I've bid at auction a few times, and often I probably find I'm trying to buy it as an investor. I'm not prepared to pay a premium, so I end up not buying a property all the time. And for that reason, as a buyer, I don't necessarily love the auction system. But as a seller, if we can create more than one person, I think the difficulty is, we've got a lot of information these days on what's sold in the street, what's there, what the sort of the value should be. But if someone really falls in love with it and does have the money, they might pay more money.
Yeah,
and that's what you're really trying to make happen. As long as it doesn't create a situation where people are overpaying what they should, got to set what your price you can pay, and not be prepared to go over that. Hence, Brad doesn't end up buying at auction very often. Yeah,
no, I'm the same. I don't buy at auction either, probably for that reason. And I absolutely encourage all of our clients not to buy at auction as well, because I think from an investor's point of view, on your way in, you've worked out exactly what you need to pay in order to get the yield that you've got. And if you can't, you know, if you go over that, then you're not going to get the right yield.
And often you're looking, I'm looking at things I wish to do some sort of development on or add value in some way, and then I spend a whole bunch of time trying to work that out, and then it goes for a different price.
Absolutely. Look, let's go to the phones, and Luke, you're on the line tonight. Luke, you're from Sydney, and you want to know a bit about the Gold Coast market, I believe.
Yeah, that's true. Hey guys, how you going?
Very well.
That's good. Yeah, I'm just looking to buy up there in the next sort of couple of weeks, early months, and I understand, you know, conditions were tough a couple of years ago, but sort of it's starting to it's in the recovery phase, spurred on by, you know, the infrastructure works associated with the Commonwealth Games. You've had the light rail network project and a couple of other things. What do you guys see the future as for the Gold Coast?
What is it that you want to buy there, Luke?
I'm looking at, like, I understand units is where it was really sort of stuffed up because of oversupply, but on my budget I can only sort of afford like townhouses.
Okay, so just out in the suburbs.
Yeah, like I'm looking at like Labrador, which is just north of Southport, or even further out west, which is
Yep.
yeah.
Okay, good. What do you think, Peter? I guess, you know, there's really a bit of a two-speed market in the Gold Coast.
Always has been, yes.
Always has been, with that whole broad beach surfers paradise still grossly oversupplied with apartments. But the suburbs probably aren't looking quite so bad.
Yeah, look, the Gold Coast has always been a boom-bust market, and the reality is it's been in a bust for a very long time now, and at some stage it is going to turn in vendors' favour. I'm not as dark on the Gold Coast as many others are as an investment opportunity, because I look at the Gold Coast and I say, how much lower can prices go, if at all? It's been battered as a tourist destination with the high Australian dollars as people have gone overseas and international tourists have stopped coming to the Gold Coast. So that situation has reversed itself, and it might all work in the Gold Coast favour.
I guess, Brad, the point is that if you continue to have gross oversupply, a population which is essentially ageing, so it is an older demographic in the Gold Coast, and a continuous oversupply of the wrong kind of property as they do in Surfers Paradise. And when I say the wrong kind, I mean what they're supplying isn't necessarily targeting the kind of demographics that we have. Then we can go on, there doesn't necessarily have to be a turnaround. We can go on for it ad infinitum with prices just in the doldrums.
Well, yeah, or it could be a long time, I guess is the other thing, because we, you know, it's so impacted in the Gold Coast by things like the dollar, transient workers and tourism. And it's not, it's like anything that's unusual to the market, or the fundamentals as to why to invest, is kind of can be there. It's a bit like a mining town that has a mine. If tourism isn't coming there, then it's got hurt or potential for hurt. What's it done over the long term, I suppose, is sometimes the question. And we seem to build very high on the Gold Coast, so the lack of land supply is not so much of a problem sometimes, I suppose, because, you know, we keep building up, and it needs to be the product for what that the people do want to live in, and therefore the Labradors and the not go and want to party on the weekend or go on the family holiday probably got some positive about it.
Yeah, look, I think that your budget is probably your best friend if you're thinking of buying in the Gold Coast market, and I do think that the area that you're looking in is certainly one that's got some pretty stable families there. They don't all work on the Gold Coast. Some of them work, you know, north in Brisbane, or certainly in that whole big precinct around the Logan Shire and Springfield Lakes, where we've got a huge amount of retail, we've got manufacturing, we've got warehousing, freight and logistics happening there. And the drive from some of those northwestern suburbs of the Gold Coast is probably only 20 to 30 minutes into that area where there's big employers. And so you're going to see people choosing to live a little closer down to the Gold Coast, so that on the weekend they can enjoy all of those things that you're talking about, the light rail and the beaches and the lifestyle that you can have down there, without necessarily living in all of those units, which I still believe are going to be a long time working out of this market. I think there's just too many of them. We've had quite a lot of big buildings go broke, and they've just dumped the apartments on the market. So I think there's nothing wrong with the area that you're looking in. In fact, you know, I am actually picking it as being a little bit of a warm spot for 2015. So long as you get in at the right price, you don't overpay, and you should get some pretty good opportunity, because not everybody's looking there. Just with regard to the Commonwealth Games, Generally speaking, a big event like that doesn't have a big impact on property prices. If anything, it can artificially inflate them for a little while and then they fall away afterward. You know, Homebush Olympic Park here is a good example. It was a good 10 years after the Olympics went away before we even saw any movement in that market. Well, I'm glad that you joined us this evening. As you know, every Monday night, the panel and I choose a question from either the emails or the calls, and we send a copy of one of my books. Now, this week, every question asked and answered on the show will receive my ebook, How to Achieve Success in Property Negotiations, which is a must if you're ready to buy. Call us on 1330 3435 or email property@skynews.com.au with a question, and make sure you watch at the end of the show to find out how to claim your book. And it's not don't contact us on that one just yet. I'll talk to you about that at the end of the show. We're off for a few important messages. Don't go away. When we come back, we'll take some more calls and also answer your questions. I'm so glad that you stayed with us for the show tonight. If you've just tuned in, I'm joined by real estate author Peter O'Malley and Brad Beer from BMT, and we're here to make sure that you get the answers that you need. Now, if you have a question, grab the phone and call us on 1300 30 34 35, or of course you can email us on property@skynews.com.au. Now remember, each call or email answered on the show tonight will receive my ebook, How to Achieve Success in Property Negotiations. And Mariah has a question for Brad this week. Now she asks, what is the date in 1999 that allows us to claim building depreciation on an investment property building, please? She might be a little confused, Brad.
Yes, definitely. The date is not really a 1999 date, but that's okay. It brings to light the question of a date.
Yes, and 1999 kind of rings a bell somewhere as well, doesn't it?
But you see, really, depreciation's got the two areas that we get to claim for, and there's a special date. It's 1985 actually, and 1987 really now, where we actually get to claim a part of the structure of the building called the building allowance, as opposed to building depreciation, which is kind of mixing up the words, or the capital allowance, which you get to claim based on the structural cost of that property. The depreciation actually relates to a claim on what we call plant and equipment, which is carpets, hot water services, blinds, stoves, curtains, and things that don't last as long, as opposed to the other one being the structure of the building. And there's not a special date on these things, but it does come down to a value. If we look at your carpet and it's been there since 1927, firstly, please replace it so the tenants don't have to live with it. And secondly, it's about value as opposed to age. It's a common question about older property and depreciation, and 1999 is not necessarily the special date, but
isn't that a date for something though, like structural improvements to an older property or something?
See, that's a 1992, so I was racking.
1999 kind of feels right to me for something, and I'm not.
And with the building structure depreciation, no. Now they make a few changes to depreciation legislation, effective lives, but there's not really a major amount of change that happened then that's really necessary to consider it when you're buying, because if they make it to plant and equipment deductions, they actually don't grandfather it, and you actually fall under legislation when you buy.
Okay.
That building allowance one is the one that actually matters when it was built as to whether or not you get to claim it.
Of course. Okay, well, hopefully, Mariah, that has certainly cleared things up for you. 1987 now. 1985 was a date, but anything that had 1985 depreciation runs out in 2015 because it's 25. No, it ran out in 2010,
yes,
because it was only 25 years, and so it's anything from 87 now. You've got 40 years on the building from there, and you can claim the balance of that 40 years when you buy a property. If it's already 10 years old, you get the other 30. If it's 15, you get the other 25. But everything inside, all of those other things Brad talked about, you get to get a new effective life that relates to you because you bought them at a certain value. They're valued up at that value, and then you get a new effective life. So you can start some of those things over again, which is good news as well. Paul from Cairns, how are you going up there, Paul?
Yeah, g'day. Hey, thanks for taking my call.
You're welcome. What can we do for you?
Well, after listening to your conversation at the beginning, I've got a house in Maruka in Brisbane, which is about 8 kilometres from the CBD, and now I have to sell it.
Okay.
So I didn't know whether I sell it now or I possibly can hold on to it for 6 months. However, after listening to the previous callers' comments about Gold Coast,
I'd also be interested in what your thoughts are on canal frontage, where more stock can't be produced. We've got a place at Mermaid Waters, so I'd like to see what's going to happen to that over the next 3 or 4 years.
Peter, I guess, first of all, I'm not sure that there's going to be a big movement in that 8-kilometre rim because it has enjoyed that good price growth.
Yes.
Would you agree with that?
I would, but we are in a rising market. And,
indeed we are.
Paul said he had to sell and then he said he can hang on. So I'd be saying if you can hang on for a little bit longer, ride the wave, because there's definitely one there.
He certainly won't lose by hanging on.
You would think
That's
not.
the point.
That's right. Where the greatest losses have happened in Australian real estate is on the canals on the Gold Coast.
Yes.
Multi-million-dollar losses. So I'd be very careful there. But if you're within 8 kilometres of the Brisbane CBD and you don't have to sell, I wouldn't be rushing in to sell that one.
Yeah, with regard to those canal fronts, Brad, I know that last year for my annual family holiday, where all of my kids, none of them which are still kids, come away on a holiday with me, possibly because they know that I pay for the accommodation. This year or last year, we actually went up to the Gold Coast and we stayed on one of these fabulous canal properties. And this was an amazing property with a theatre room that seated 8 people in big recliner rockers, and I think it had 5 bedrooms and 4 bathrooms and absolute canal front and a pool and everything that opens and shuts, and it was a massive, massive big house. And it was $450 a night for this massive house, and there was 10 of us in there in the end when everybody comes along. So I guess really they've been one of those things that were oversold and people paid an awful amount of money for them. And not only have they lost value, but they're just not getting a good yield either.
Well, especially at that sort of numbers when you consider it's not going to be, that's not a permanent rental either.
No.
And there's been much hurt in that space, I suppose, and has it all run out as far as space is concerned? And we can probably build more canals if it's that much demand for it, I suppose. Not that you probably would in the near future, but so much hurt already. It almost goes back into that other market of the apartments as opposed to the normal Gold Coast. So, I mean, depends what you want to do with it. Was it bought to live in? Was it bought for what?
And look, I'm not sure about that demand either, Peter. I know that the area, there's some fabulous houses there, but there's also some very tired houses around those canals in the Gold Coast as well, and around Mermaid Waters. There is a lot of them. I know that the caller says that, Paul says that, given that there's no more space for canal properties, but there's a lot of them on the canal. There's a lot of canal properties around there.
The supply's plentiful as it is.
Big supply anyway.
Right.
And I think they probably rent. I actually know someone who rents a house on one of them. It's a big house he rents, and I think it's $600 a week he pays in rent. And you'd think that the value would be $1.5 million, possibly $2 million. That's a low yield.
No, it's a non-existent yield. I think the greatest value on the canals would be leasing those particular properties. It seems like every month we're seeing a prominent Australian who does a couple of $1 million on a property up in that part of the Gold Coast. So, Paul, if you get the opportunity to exit your property at a profit or a break even, it might be time to dip out on that one.
Yeah, if you've certainly got one there. And Brad, there's nothing wrong with getting a low yield on an expensive house if the house also grows. But if it doesn't grow either, then you've got no way to recover that low yield.
And often with really high priced property, a lot of those probably should be a different question for you sometimes. If this is the house that I want to grow up in, raise my children, and you overpay a little based on that, then so be it. That's what you want. As an investor, you're punting on growth so badly when you're kicking in so much in order to hold it. Then renting at the top end's often not a bad idea.
Well, this is Your Money, Your Call, and although we're having a great time, we do need to take a break. It won't take long, so stay tuned and perhaps even call us now on 1300 30 34 35 or email us on property@skynews.com.au. We'll be right back. Welcome back and thanks for watching. I'm Margaret Lomas and with me tonight is real estate author Peter O'Malley and Brad Beer from BMT. Now we've had some really good questions tonight, but we do have time for more, so get to your phone now and dial 1300 30 34 35 or email us on property@skynews.com.au. Remember, if we answer your question tonight, you will receive a copy of my ebook, How to Achieve Success in Property Negotiations. Now before we do go to the phones again, and in case you haven't booked, here is some information about my upcoming roadshow seminar, which starts this week, and you can be there. Every week I travel to major capital cities and present a market update and investor seminar where I release my new set of areas to watch. Now it's a 2-hour seminar held in the evening, and it's always a great night. This year it's kicking off tomorrow, Tuesday the 17th in Brisbane, and then I'll head to Perth on the 18th. And then next week it's Melbourne on the 24th and Sydney and the online webinar on the 25th of March. Go to my website destiny.com.au and check out the details and the very low ticket price, and I hope to see you there this year. Tom from Victoria, welcome to the program, Tom.
Yeah, g'day Margaret, how are you?
Pretty good. What are you up to?
I'm sitting here relaxing watching you actually. I have been for a few weeks.
Good.
Yeah, look, our son's been re-employed and he's leaving Bushland Beach at Townsville, and he's looking at the property market, and it's obviously if he sells now he'll probably take a 10% hit, and if he leases or rents he'd probably have to top it up.
Yes.
It's one of those house and land packages out of Bushland Beach, which is 20 k's out or thereabouts from Townsville. Just wondering if it was yours, would you be selling and taking a hit, or hanging on and hoping for a rainy day?
Okay, we can't we can't give obviously advice to disinvest, but let's just talk generally about the Townsville market. Are either of you up to date with what's happening in Townsville?
It's very weak, so I'm not surprised to hear that there's a bit of a loss there, unfortunately.
Especially since there were a bunch of house and land packages that were sold when people were very enthusiastic about Townsville, when they should have been buying just the established houses in some of those northern suburbs. People were buying up on these house and land packages, and they were overpriced.
Yes, indeed. Well, I'm not sure what price our caller went in at, but he's pretty confident that he's sitting on a loss. So if you're propping it up each week, you're taking the loss on a weekly basis. If you sell out at a 10% loss, you've locked in the loss, and you know what the loss is, where just because you're taking a weekly loss for a period of time, you don't know how long you're going to take that loss until you're back into profits. So if there's no need for the property going forward for your son, I would be nearly inclined, Tom, to suggest that his money can be used better elsewhere.
Now, I'm gathering from Tom that the son lives there at the moment. He'll move out and turn it into a rental. I'd suggest, Brad, that Tom's probably thinking that the rent won't cover the mortgage, but if it's a new house and land package, there's going to be a bucket load of depreciation there.
And that was probably going to be my first comment. The cost of holding it after tax, when you factor in depreciation properly, Steve, the same with previous callers. Do you have to sell? What is the cash flow really if you make sure you claim all your deductions properly? Because I see so many that don't, and on that particular property, as you say, there'll be quite high deductions. And I think then the other part of the scenario is the question of is it stopping you from investing elsewhere? Elsewhere. Otherwise. Is it stopping you from doing that? And what's the damage to you if you do hold on to that property from an overall perspective? Because I've got properties that I wish I didn't buy, and I haven't sold them. And why? Because they don't stop me from doing other things. If they did, I'd probably look harder at selling them.
Yeah, look, some really good advice, Tom. The first thing you really need to do is maybe even give BMT a call. I know Brad won't mind if you give them a call. Find out what you're looking at in depreciation, and if you don't know how to do it yourself, have someone work out what your after-tax cost is really going to be in that property. You can even download the Destiny app, which is free, from the App Store, and have a look through there. That can do all your cash flows for you, and it'll hook up with BMT and download some of their depreciation as well. So that's the first thing you've really got to establish. What really is the loss here, and is there a loss? I'd be surprised because the yields in Townsville aren't bad, and even if you did overpay, you're going to get a fairly big amount of depreciation on that property, which should top it up, and you can get that weekly in your pay as well. So that's important to note. But Brad's point is correct. If you've got to work out what it's stopping him from doing. If he can't borrow to do any more, then it doesn't matter whether it's going to go up or not. He needs to get rid of it so he can get into something a bit more opportunistic. If the property's sitting there doing nothing, it's okay to let it sit there if you can still go on and it doesn't hold you back. If it's going to hold him back, then maybe cut the losses now, get into something with more opportunity. But get some good advice from someone who knows how to work those things out for you rather than just try to work it out for yourself. Chris from Sydney, how are you going, Chris?
Good evening. Thank you for taking my question.
You're welcome.
I got a question. I'm interested to buy the property in Melbourne. Southeast, north from Dandenong, south from Oakland, around Noble Park, north Noble Park, Springvale, Melgrave. What suburb did you recommend it for potential?
Is this for an investment?
Investments and a living for the family member.
So you're going to let someone live in it when you buy it?
Yes.
Will they rent that from you?
Yes.
And will they pay market rent?
Yes.
Okay.
Full market price.
Just making sure that the tax officer's satisfied there, Chris.
Yeah.
What about Melbourne? Where do you think the opportune markets are at the moment, Peter?
I think around Methven, like around that part of the world, Lilydale. Yeah, good family parts of the world. Yeah.
Okay, yeah, they're not bad places. What about you, Brad? Is Melbourne an area that you think is worth investing at the moment?
Well, I did actually buy there last year, late last year.
Where did you buy?
I probably didn't tell you that. In a suburb not far from the airport, and
Sunshine.
Glenroy, actually.
Glenroy, yep.
And smaller, and it's just something that popped up, you know, so I'm positive about Melbourne markets in the right place, but it kind of fit the criteria of the thing I normally buy. It's a bit of a slightly lower socio-economic area, and I got it in at a decent price, and I still think it's got some positive, and it doesn't have my big land tax bills attached to either. You know, you're out of the CBD, probably is something that's, there seems to be a fair few of those coming along, so probably not my first choice. But the actual Noble Park, etc., I don't know. Margaret, what are your thoughts?
Well, look, Melbourne had a better year than everyone thought it was going to have in 2014, and it returned, depending on who you're subscribing to in terms of data, and trust me, it's different, whoever you listen to, but let's say somewhere between 6.5% and 8% growth across the entire Melbourne, which was a lot better than expected. It's forecast to have a similar year again this year. So we're looking at possibly around the 6% growth in Melbourne this year. Nobody's expecting any big burns, but nobody's expecting it to be very, very flat either. I'm thinking that around Noble Park might be okay, but my money is more on some of those southeastern suburbs around Cranbourne and Berwick, or the west, kind of a bit north suburbs around Sunshine, and some of those areas there for 2015, 2016. I think when we get into 2017 and we start to see more interest come into Melbourne, then the inner city, I think, is shot for quite a long time because there's so many apartment markets, and I think that's when we're going to see the areas like Noble Park that you're talking about begin to see some growth then. So that means if you buy it today, you're still going to be in a pretty good situation. Brad, you're indicating to me you want to say something.
I think you've also got another question. The person who wants to live there
maybe
doesn't want to live anywhere in particular. You're buying it and you're going to have a family member rented at market rent. And if they don't want to live at Sunshine, that's not really going to help you out a lot, is it?
Exactly. So, yeah, find out where your person also wants to live, and I guess you'll go from there. Well, time is running out and we need to take one more quick break, but you might still be able to get your question answered if you hurry to the phone, and then you will receive a copy of my new ebook. Call now on 1300 30 34 35 or email us on property@skynews.com.au. Welcome back. It's been a great night with real estate author Peter O'Malley and Brad Beer from BMT answering your calls. Our lines are now closed, but during the week you can email your questions for next week to property@skynews.com.au. And we just have time for these last couple of callers who are waiting on the line. First of all, Mort, you're from New South Wales. How are you going, Mort?
Yeah, I'm good, thanks, Margaret. How are you?
I'm pretty well. You want to know about the Central Coast?
Yeah, I've got a few questions.
Okay.
Basically, looking for the panel's outlook for Central Coast, particularly around Greenpoint.
Okay.
We've currently got our family home on the market.
Yes.
And our plan was to sell this one, downsize and buy a specific rental property.
Okay.
Now, we've already got one house up in Brisbane, which is doing well.
Good.
Now, some of the people going through the house have been investors, and the quoted, we didn't do our due diligence quite well enough, but the quoted income was equal to the sale price, as in $700 per week, and the asking price is $700,000.
Yes.
So now it's making us have a little bit of a rethink about our strategy in buying a lower value investment property. We didn't quite think that this was a good product for an investment, and now we're having a rethink.
Are you thinking of keeping it?
Yeah,
Mort,
we might pull it off the market.
Mort, do you have a mortgage on that property?
Yes, we do.
Is it a big one or small in relation to its value?
In relation to the value, it's quite manageable. It's only at $460 at the moment.
Okay. All right. Now, Mort, let me go to the panel and ask them some questions here. And I'm glad that Mort specified where it was in Greenpoint. A lot of people don't realise that the Central Coast is quite large over 2 shire councils with 400,000 people. It's not a small little town, even though it does have the feel of that. Are you familiar with what's happening in and around Greenpoint?
Somewhat. What I would say there is the Central Coast has not experienced anything what Sydney or Western Sydney has experienced, Mort, and sooner or later genuine and good growth will hit the Central Coast, and if you don't need to sell the property, maybe riding the wave for a little bit longer is a good idea.
We're seeing some really good sales prices coming through just in the last 6 to 12 months on the back of the Sydney growth, Brad. Greenpoint is in behind Terrigal essentially there, and Terrigal's really experiencing some considerable growth there. And I'm just wondering, I guess my biggest concern for Mort is that he's hanging on to a former family home that doesn't have sort of a massive mortgage on it. What do you think?
See, and the mortgage is a very good question, because the deductibility of the debt in an investment property is one of the things that wherever you've got money and you want to buy your principal place of residence, you kind of want all that money tied up into the principal place of residence, and getting rid of your non-deductible debt and any of your debt to be as deductible as possible. With that sort of situation, great, you've probably paid it down a little bit, but then it actually doesn't give you the flexibility of being able to achieve that result. Now, a tax issue is not the only reason to buy a certain type of property either, but you've got the potential of a tax-free capital gain on that property that you might be able to take depending on when you've bought it and how much you've paid for it, that then gives you the flexibility to use that money to either invest or to put some into another principal place of residence if that's what your intention is, and just get the use of the money proper. Depending how long you've owned it, you've bought it as a family home, which may not always make it the best investment. It's also pretty high priced, meaning that you might be able to split it between multiples and reduce some of the risk associated with investing, I suppose. A couple of my thoughts.
Mort, some good advice from both panel members there. Peter's right, there hasn't been any growth on the Central Coast for a while, and now suddenly we're starting to see it on the move, and I will see that that will continue to go, so your property might become worth more. My greater concern for you, though, is that if you do decide to move out of it, and you decide then to rent it out, and hopefully it'll grow a little bit more, you're renting that out with a $400,000 mortgage, but then you're going to have to raise a debt to buy a property for you to live in, and it might be another $300,000 or $400,000 that you raise for you to live in, and that will be a completely non-deductible debt. Instead, if you sold it when it was in its capital gains tax-free period, which is now, because it's your own home, take all of the money that you have left over, which is going to be roughly in the region of about $300,000, use that to buy the new house and maybe get a smallish mortgage of $100,000, and then you've got newly created equity in the new property which you leverage back from to buy another rental. And that way all of your debt is sitting in exactly the right place. What you do need, Mort, is you need some really good advice from a qualified property investment advisor who's not trying to sell you a property. So someone who doesn't sell property or introduce you to people who do, so that you can make sure you get this structured correctly. You might want to hang on to Greenpoint to get a little bit more growth out of it, but the tax-free gain taken now might get you into something else on the coast that will also grow, and it might even grow faster than Greenpoint. Greenpoint's up there, and so it's not going to have as much growth as somewhere like, say, Bateau Bay, Berkeley Vale, Killarney Vale, and some of those northern suburbs will definitely have, which is where I'm predicting that the growth will go first, even Gosford. Well, Michael's question is to the panel, and he's looking at buying in Sydney. He asks, I have an investment property in Queensland. If I were to buy a property off the plan in Sydney to live in, do I qualify for the first home owners grant?
A couple of criteria here. First of all, you cannot have gained the first homeowners grant in another state. That's probably the big one that people will look at from there. Brad?
And look, criteria is the thing, can't have gained it, I think, and providing you fit the rest of it, I understand, providing you haven't bought a property for your first, as your first home, then you potentially could do it.
Yeah, it's going to depend all on when you bought the property in Brisbane, because I don't know the exact dates now, but it was roughly around about 5 or 6 years ago when the rules changed slightly. So you could have as many properties as you want, and as long as you don't live in any of them, then you can still access a first homeowners grant if you've never gotten one in any state for the first property that you buy to live in. So the criteria is that you can't have owned and lived in a property anywhere in Australia, and there's a date there. Now, you can get that date by looking up the Office of State Revenue, and you'll see in your state or in New South Wales, and you'll see the criteria there, and it'll tell you what that criteria is. But you're probably okay providing you haven't owned that property in Brisbane for too long, and providing you did not get a first homeowners grant of any description, and you have never had one at any time in your life. Roger from Melbourne, how are you going, Roger?
I'm very well, thank you. How are you?
Pretty good. What's your question for us?
Right. About 6 or 7 years ago, I purchased 2 larger properties in Cranbourne proper.
Yes.
And I was just wondering, with the idea that possibly in about 6 years' time I might be, because I bought them in my self-managed super fund,
okay,
and I may be in a position where I'll have to sell the properties to continue my retirement. I just want to know where you think Cranbourne's heading at the moment.
Yes. You've already seen a bit of a gain there though, Roger.
Well, I don't know, because I keep looking up at the prices and they don't seem to be going anywhere. And when I rang my managing agent, he told me the problem with Cranbourne is there is so much vacant land there that the builders are getting in and building these small properties on postage stamp blocks of land, and are keeping the prices down.
And unfortunately for you, because it's in your super fund, you can't develop them, which is one of the drawbacks of super fund that a lot of people don't realise. They buy these nice big blocks of land, which of course these days people don't necessarily go looking for anymore.
Yes.
And you buy them if you think you can develop them, but you can't develop in super funds. Do either of you have an opinion on Cranbourne?
What I'd say is this is testament to why investors should look for positive returns, and negative gearing is not what it's cracked up to be. Not to say that our caller was negatively geared on this particular project, but you can't rely on capital growth. But if you go into an investment which is profitable from day one, any capital growth that you get is
a
an added bonus.
That is true. And of course, being in super fund with only 15% tax, the whole negative gearing argument's a bit of a wash anyway. But Cranbourne, you know, it's pretty much out there in Mortgage Belt.
Yeah, so from an area perspective, it's got some of those things that are positive, but because the fact that you've got the new house and land packages going up everywhere on smaller blocks means maybe they're better things for development at future at some point, which is maybe why you bought them, not knowing so much land's going to be released. So that's not great. It's like self-managed super or any type of vehicle that you put it in other than own name or trust that do work, that give you the flexibility to do what you may need to do based on things that do change in the future, is always fraught with a bit of difficulty because it takes away your flexibility, I suppose.
Absolutely. Look, Roger, I still think Cranbourne's got a lot going for it, and I think it will have for many years to come. You will see some generational growth there, so it isn't going to boom, and the house and land abundance is one of the reasons, but it's going to continue to be developed. There'll be continuous families moving into that area. You know, already we see, if we go past there and up into Pakenham and Berwick and Narrawarren and those areas, we can see them growing really well. I see that Cranbourne's going to suffer the same fate, and over time it is definitely going to grow really well. But if you need to sell those properties, then chances are that if they are on big blocks, and I don't know the size of the blocks, although you can't develop them because a self-managed super fund can't be a developer, you might be able to sell them to someone who wants to develop them. So if they're big enough and they can be subdivided or at least made into dual occupancy properties, then it might be something you can consider. And you might even take that extra step and find out more about it and even have some architects' concept plans drawn up, help potential buyers to see what they might be able to do with those properties, and therefore then you might be able to attract someone who just doesn't want the postage stamp size block of land and house, someone who really wants to do something in the future with that particular property. Well, Sue is tossing up which property to buy, and she asks, I'm researching for an investment property and I'd like your opinions on buying an apartment versus a townhouse. My concern is the lack of owning actual land with an apartment. Is it a good long-term investment? Brad.
Look, I think the answer to that question probably depends on where you actually are. In some areas, people want to live in apartments, and some people, they prefer townhouses. So where you are actually is probably more of an important question about apartment versus townhouse. Apartments have more strata fees and things. They have high depreciation. If it's investment, it really comes down to probably what's needed in the area you're thinking of investing in.
Yeah, I think that's the important thing that investors miss. They sometimes want to go into an apartment or into a townhouse thinking that it's the cheaper option. But if the demographics of that area don't want that kind of property, then it's going to cost you in the long run because it won't grow as well. So find out first who is going to be your tenant, and then find out what they want, and that's what will grow. It is possible for an apartment or a townhouse to grow faster than houses with land around them if that's what is in most demand in that particular area. And that brings us to the end of this week's show. I'll be back next week, and joining me will be Ben Kingsley and Damien Collins. So get those questions sent to me during the week. Thank you to my guests this week, real estate author Peter O'Malley and Brad Beer from BMT. You'll see both of them again very soon. Thanks also to all of our callers. Now, if everyone who called or emailed tonight and had their questions answered on the show, that's the important criteria. We had to have dealt with your question tonight on the show. If you could email me on yourmoneyyourcall@destiny.com.au, and there it is on your screen, yourmoneyyourcall@destiny.com.au. I will send you all your ebook, How to Achieve Success in Property Negotiations. You can also follow me on Twitter, Margaret Lomas AU, and if you visit YouTube and go to Channel Destiny, you can watch some really great video at the moment. We're doing viewer questions and answers, and the 20 questions are also up there for you to watch and find out more about. And there it all is on your screen, where you can find me all over the shop, every kind of social media you can imagine, websites, the whole lot, it's all there. Don't forget to grab tickets to my roadshow seminar starting tomorrow, Brisbane and Perth. People, I will see you tomorrow and Wednesday. Thanks for being with us. I'll see you again next week.